Japan is the world's largest creditor, and at the end of 2021, it held roughly $3.2 trillion in foreign assets, 30% more than Germany. As of January, it owned over $1 trillion of U.S. government debt, which is even more than China. Japanese banks are the world's largest cross-border lenders, with nearly $4.8 trillion in claims in other countries. But now things are taking a drastic turn, and this may be a threat and shows how integral Japan is to the global economy. This graph measures the competitiveness of a currency. It is a measure of the value of the yen against not just one currency, but a basket of currencies. As you can see, the yen today is as weak as it was in the 1970s. That's 50 years ago. The value of the dollar has been heading up since the beginning of the year, and that of course means the value of the Japanese currency has gone down. It fell to 151 yen to the dollar, its lowest in decades. This drop is driven by a wide gap between interest rates in Japan and the US. In Japan, the central bank has been maintaining the overnight rate and the long-term 10-year rate at around zero. In the United States, meanwhile, the Federal Reserve has been raising rates overnight, right now ranges between 5.25% and 5.5%. And that's why investors are selling yen and buying the US dollar to get higher rates. As a result, there is less demand for yen and its value diminishes. Even as central banks elsewhere have raised interest rates in recent years, the Bank of Japan has stuck with its ultra-loose policy designed to stimulate growth. Japan's benchmark interest rate sits at minus 0.1%, where it has been for 7 years. And on October 31st, despite building pressure, the bank decided merely to tweak its cap on 10-year government bond yields. Though the yields on the benchmark bond are at 0.95%, their highest for over a decade. The Bank of Japan said it's maintaining an allowance band of around plus or minus half a percentage point, as well as a hard cap of 1%. Many expect the central bank to end its yield curve control policy by the start of next year and to have raised interest rates by April. But even when the Bank of Japan does finally raise interest rates, it is likely to be by just a fraction of a percentage point, meaning the gap between Japanese bond yields and those in the rest of the world will remain large, with major consequences for global financial markets. To understand why, consider the impact Japan's rock-bottom interest rates and continued intervention to suppress bond yields have had. Low rates at home have generated demand for foreign assets as investors seek better returns. Last year, the income from Japan's overseas investments ran to $269 billion, more than what was made by overseas investors in Japan, the world's largest surplus, equivalent to 6% of Japanese gross domestic product. The huge gap between bond yields in Japan and those in the rest of the world now presents dangers to both the Japanese investors that have bought foreign bonds and the global issuers that have benefited from Japanese custom. Instability is particularly apparent at Japan's largest financial firms, which make big investments abroad. America's short-term interest rates are more than 5 percentage points above Japan's equivalent, and the gap exceeds the 4.8% yield on 10-year American government bonds. This means Japanese buyers now make a guaranteed loss when buying long-term bonds in dollars and hedging their exposure. The huge gap between short-term interest rates means that Japanese investors now have more limited options. One is to continue buying overseas, but at greater risk. Meanwhile, rising yields on long-term Japanese bonds, which will surely rise further. Still, if the Bank of Japan does abandon yield curve control, it may tempt local investors to bring home their money. Japan's 40-year bonds offer yields of 2.1%, enough to preserve the capital of investors even if the Bank of Japan hits its target of 2% inflation. In such a scenario, a source of demand would turn into a source of pressure on the funding of Western firms and governments. The yen might then surge as Japanese investors sell foreign currency debt and make new investments at home. The flow of Japanese capital to the rest of the world, which emerged during a decade of easy monetary policy around the world, looks likely to be diminished. Whether the resulting pain will be felt by local financial institutions or foreign bond issuers or both will become clearer over the months to come.